Okay, the RBA increased interest rates yesterday by a further 25 basis points, taking the cash rate to 3.1%. So that's the eighth increase this cycle where they've increased interest rates overall for 300 basis points in a very tight time frame, so 7 months, which is the most aggressive time frame, sort of at least for the last 40 years. The main purpose or the main reason for the RBA's move this cycle has been around inflation, which obviously is increasing on the back of various factors. The war in Ukraine, supply chain issues following COVID, and general floods and food price increases and so on. So the focus is to get inflation back towards the 2 to 3% target range. And at the moment, there is still that very strong underlying growth in the economy and household spending, which is driving prices up. So at the moment, the cash rate's 3.1%. The market pricing for where the terminal rate will be, which is the rates cycle will peak at, is around anywhere between 3.6 to 3.85%. Consensus, which is amongst the street analysts, is around 3.6%, with some more dovish speculators around 3.35, but the most people around 3.6. So based on that, we have at least another two, maybe three 25 basis point rate hikes between now and, say, May next year, which is potentially when the peak is expected to come through. A key consideration in answering this question is what percentage of the market has a fixed rate mortgage? Now, traditionally and historically, around 20% of Australian mortgage holders have their rate fixed at any given time, meaning around 80% are variable. So when the RBA increases interest rates, we get a very almost immediate, albeit with a slight lag, impact on household budgets because of the increase in interest rates. This cycle, however, we see some 40% of mortgages fixed, a direct result of low interest rates last year. Households took advantage of that and fixed their rates for quite a period of time. So when the RBA has been increasing the interest rate this cycle, the impact on households has been more muted than in previous cycles. And it creates challenges on the RBA of whether they go too hard or too slow, where if they go too slow, inflation becomes a more entrenched problem, or do they go too hard? And when these fixed mortgages do roll off, households are much more weakened and we slip into a recession. So that's the challenge for the RBA at the moment. And at this stage, it's probably too early to say whether they are on track or off track on increasing rates appropriately. So the most obvious question is, what is the impact on house prices? And we've seen house prices peak around April, and they've come off quite a bit since then, sort of 11% on average, which is alarming in its own right when you consider it's only a 6-month move. But it needs to be taken in the context of recent history. And last year we saw, in 2021, house prices rise sort of 28% on the back of cheap interest rates, and historically low interest rates. So what we're seeing now is a bit of a reversal of that process. And at the moment, consensus has house prices falling 15 to 20% from peak to trough. We're halfway there, if that consensus number is correct. Now, while that is an alarming fall, what it really does is it just takes away what we saw last year. And a 20% fall in house prices takes us back to where house prices were pre the COVID. And sort of back to the long run trend. So all up, it's not a bad outcome. Takes a bit of heat out of the market and is probably what is needed at this point in time. Mutual funds are heavily invested in floating rate notes. It's our core competency. And as interest rates rise, as we've seen through the cycle, floating rate note coupons adjust in line with that interest rate. So it creates a growing income profile for investors. And it creates a lot of capital stability as well that you don't get with fixed rate bonds, which are subject to a lot of volatility around rising interest rate environments. So we remain well positioned. The funds are performing very well and meeting our targets comfortably. And we are seeing good inflows across the funds.